For more on the latest market moves, let's get to Tony Roth here, Wilmington Trust CIO. Wilmington Trust has over $79 billion in assets under management. Tony, it is good to see you. So talking there with Julie Howe, we did get that economic data today, Tony, and it was weaker than expected. ADP weaker, ISM services weaker. But stocks, Tony, I mean, the SPX is up today, albeit slightly. Just curious to get your take on the market moves.
Yeah, I think that the market is a little complacent right now, to be honest. The environment is one where there's continues to be a tremendous amount of macro uncertainty with respect to both tariffs and the degree of further debt load that the country is going to be taking on over the next decade due to the big, beautiful bill. And so the market at these valuations is not really pricing in negative outcomes for those issues, which are really the defining issues of the next 6 to 12 months in the market. And so if you think that those issues are going to resolve to perfection, then I think these levels are justified. But if you think that the process of working through trade deals will take longer than July 7th, then I think you're going to see a pretty flat economy for the rest of the year. And if on top of that, we have if you will, a spasm in the bond market because of the amount of debt that's being taken on. People walk away from long-term treasuries, and the long end of the curve, the 30-year point of the curve, is the place to see that happen, not really the 10-year, which is more tied to short-term inflation. Then that's also going to weigh on markets. So at the moment, markets are probably overextended. And it's not to say that we necessarily get a big correction from here, but I wouldn't be surprised to see one.
And so what do you think is a more appropriate level then for stocks right here that would sort of capture fair value better than where we're seeing them trade right now?
Yeah, it's a great question. We're a couple percent above below all-time highs. So 5 to 10% lower than I think where we are today would probably make a lot of sense. The other thing to keep in mind is that even if we do have the perfect outcome on tariffs and a reasonable outcome on the big, beautiful bill, which would be to say the Senate takes at least a few hundred billion dollars out of the expected additional debt that the country takes on, we're not expecting to see growth really for the rest of the year. We're expecting to see a technical bump in growth in the second quarter as a result of the slowing of imports. And then in the third and the fourth quarters, a pretty flat overall real GDP picture. Maybe no growth at all, maybe even a slight contraction in the third and the fourth quarters. So that does not set up for a market environment that is overly appealing. Now, having said that, there are some drivers. I think that the reignition of the tech and the AI trade is interesting, and we believe that the Fed will start cutting probably in July. It may not be to September, but regardless, we see 100 basis points of cuts between now and the end of the year. But that's not going to be in the context of good growth. It's going to be in the context of weak growth. And those cuts will be driven largely by the third rail of growth really decelerating.
What about, Tony, that big, beautiful bill, the Trump budget bill, the tax bill? What could that mean in terms of stimulating the economy ahead?
So I think it depends more than anything on the amount of deficit that the bill takes on for the country over the 10 years. Because we're almost certain that there's going to be a front loading in the bill that favors companies from an expensing standpoint, and that provides additional incremental tax relief for consumers, whether it be child tax credit, whether it be SALT relief, et cetera. So there's going to be some front loading of stimulus in the bill, but that will be more than offset by tightening of financial conditions if we see the spasm in the 30-year Treasury, because we move from let's call it a $3 trillion expected additional deficit or debt load for the country over that 10 years to only 2.9, let's say. I know that the Congressional Budget Office came out today with a number closer to $2.5 trillion. I wouldn't believe that number. The real number by all the truly independent quasi-governmental entities is more around $3 trillion right now. So if we get a smaller bill with the front loading, as I expect, regardless of the size of the bill, that could be very positive. But his history shows that these senators don't usually have a lot of courage, if you will, to push back on the president.
And so when you put all of these elements together, Tony, what are we looking at in terms of recession odds at this point? And what are the implications for stocks, which of course tend to usually predict the recession. So I don't know when that would put the time, if the correction you were talking about could potentially reflect that.
Yeah, so I would say 55% chance of recession. And I would say that as we approach July, one of the interesting features of the environment right now is the so-called taco trade, where the president has now been called out, in a sense, of backing off whenever we get to a point where the tariffs get so high that they risk imperiling the growth of the economy. And so if, in fact, that's going to have the opposite impact and cause the president to hold his ground with these higher tariffs in July, then that's going to be very problematic and cause those recession odds to shoot up pretty significantly. On the other hand, if somehow they get these trade frameworks done, whether they actually improve the terms of trade or whether they're just more window dressing in order for the administration to find an off-ramp here, is not important to the market. The point is that the market needs to see any alternative other than significantly higher tariffs than the average of 10%. So that's sort of that balance that is trying to sort of work itself through as we approach these critical dates in the beginning of July.
Tony, on the Trump tariffs, the president did make some news there today. He was posting on social media this morning saying he likes Xi, but saying very tough to make a deal with. So sounding a bit frustrated there, perhaps. I'm just wondering, as a CIO, Tony, when you see those social media posts, they certainly get attention, they make headlines. How do you try as a CIO to think through them? How do you navigate that dynamic?
Well, it's very tough because we have an economic-led investment process, which means that we think about where the economy is headed. And if the market is not fairly valuing prospects for the economy, then it's an opportunity to take advantage of that disconnect. Right now, such disconnect would seemingly exist, namely that the market is pricing in a better outcome than what we are forecasting for the economy in a scenario-weighted set of probabilities. The reason that we're not underweight, though, risk is because right now, we think that there is, again, this taco trade. The president has shown himself to be fairly reactive to prospects for economic growth, which would suggest that tariffs are not going to come back in as strongly as they might if he was more resolute, in a sense. So that's one thing. And then on top of that, we have, as we've talked about, the potential stimulus from the bill in the short term, which is going to be front-end loaded. We have significant monetary stimulus coming. And so even though we expect to see that recession in the second half of the year, it will be a mild recession. And it's entirely possible that the market looks through that recession to the growth that we expect will then ultimately come in 2026, in the first quarter of 2026. So as longer-term investors, to try to time that possible drawdown in front of the recession is really tricky and probably too cute for us. And that's why we haven't moved to an underweight right now.
Tony, good to see you. Thanks so much for joining us.
Yeah, thanks for having me.